Okay, welcome back. So, again, now we're moving on to another chapter or another section, which is they're kind of related in regards to understanding what receivables and bad debt is. Okay, so when we talk about receivables, right, we are looking at accounts receivables, right? When we give the opportunity to um, allow customers to owe us money by having them place it on an account. Okay, so we create an accounts receivable to allow when we sell products or services and that we have our customers owe us money. Okay, now again, another way of understanding this is it's another form of way of having cash or some kind of credit with us, right? So when we have relationships with our customers, right, we allow them to give them credit so they can purchase whatever they like in the store and charge it on a credit and they pay us back later. Now, and we also start collecting information from our customers so we can create those profiles as well as be able to mail them out so we can know who owes us and for what amount that they bought from us. Okay. Now, of course, when we have that, there's always going to be that 1% of your customers that end up not making those payments. And that's where we're going to be introducing you to what's called the allowance for doubtful accounts. Now, in reality, right, when we allow people to owe us money, right? That means we have a potential risk that some of these customers could fall on their payments, all right? And their reasons could be infinite, right? It could be that maybe they lost their job, maybe they can't afford to pay this month, maybe they were sick for a whole week, so they can't afford to make the payments on time. Or another example would be they just simply just don't want to pay. And that's the situation that we have to come into. We have to face the facts when we allow customers to owe us money. Of course, there's different ways that the system can filter out whether someone is eligible for a credit line or not. Again, you're not going to just trust someone out of nowhere to say, hey, you owe me $1,000. Okay, great. I'm going to put it on an account. Okay, so then you're going to pay me back $1,000. So once again, once an IOU is created, or in this case, we treat the IOUs as accounts receivable, you have to understand that there is a risk that we may never collect it. Okay? And this is where we need to create what's called a contra account for the allowance for the doubtful accounts, which is a contra account to accounts receivable. Straightforward. Okay? Now, in this case, when someone faults on their payment, they give us a call or they just simply just straight up don't reply to us and they ignore us. We know exactly who, right? Because we're the ones that are contacting them in regards to their payments, okay? And we know exactly how much they owe us because we have all the account information. We have a record of all the sales items that we sold to them. And lastly, of course, we know exactly when. If we decide to send an October statement and they ignore us, then we're going to send them one in December and they choose to ignore us, then we know exactly when it occurred. It occurred in October, right? So in this case, these are the 3 contributing factors for us to recognize, okay, that means we need to use the allowance for doubtful accounts to recognize that this person isn't making a payment. Okay? So how do we actually journalize this? So this is how we journalize it. So this example here, we have on December 16, Mr. Sanchez buys $100 worth of toys on an account and he pays $20 every single month and starting in January, okay? Then March rolls around, March 20th rolls around and he files for bankruptcy and he can no longer make his payments. So first thing we're going to do is we're going to recognize first thing that happened was that on December 16th, he decided to purchase his toys, right, on an account. So there we go, accounts receivable. And again, we sold him $100 worth of toys. Now, of course, you're going to also record that you received payments for January and February. And then when March rolls around, all of a sudden, he can no longer pay you, okay? So then we know the exact date. So March 20th rolls around, and we know that, well, so far, Mr. Sanchez has made 2 payments, right? He made his payment in January, and he made his payment in February. So therefore, he still owes us $60. So in this case, we know exactly how much he owes us, and we know exactly when he decided to fault on his payment, right? We sent him a letter. He ignored it and missed his payment. So now we're going to contact him to figure out what's going on. So then that's where we need to place this in a placeholder, because this is considered potential bad debt, okay? When we have a possibility that those $60 could be something that we might not ever receive, or we might get a possibility of receiving that money. But in this case, we need to put it in accounts, in a separate account, so we don't confuse with the ones that are guaranteed for them to make a payment for us, or for sure that they haven't missed a payment yet. Okay, so in this case, we're going to transfer this $60 amount out from the accounts receivable and transfer it into this account called the allowance for doubtful accounts. Okay, so once again, and then here, again, because it's temporary or it's a placeholder account, we are not sure if he's going to give us the money back. However, we still have the possibility of collecting this debt. So this way right here, we're not permanently writing it off. All we're doing is we're just placing in a temporary placeholder just in case this does eventually become bad debt and Mr. Sanchez just doesn't pay us at the end of the day. Okay? So let's talk about bad debt. Right? Now, bad debt is where at the end of a given accounting period, where we've exhausted our total, our amounts of trying to get people to pay us, right? And we've basically what we have to do is we need to make an assumption, because the IRS allows us to write off a specific percentage off as bad debt and not take a huge penalty for it, okay? And that is up to 5% of a business. Now, in this case, right, they allow us to take up to 5%. Now, what is bad debt? Bad debt is confirmed that you are never going to be receiving this money. So this bad debt could include any over or underpayment, so people who haven't paid you in over a couple months, or it could just be a rough estimate of random people, because again, we cannot predict every individual person's life. We can't predict what they do, what kind of job that they have. We can't predict their lifestyle, what they do with their money, right? We can't predict whether they're going to be having their job the next day. No one can predict that. So what we can do here is we can make a rough estimate to assume that realistically 5% of your sales is not going to be collectible. And that's where it becomes bad debt. And bad debt means you're going to take this uncollectible debt and it just becomes a loss at the end of the day. You're writing it off as a loss. So once again, it's an estimated amount, and this is going to be called an adjustment entry. Okay? 1, because it happens at the end of a given accounting period, and 2, this is to adjust so then you know that you are writing this amount off as a loss in the current accounting period. Okay? It's not an ongoing thing, it's a for sure, and this happens towards the end of the accounting period. Okay? So in this case, because it's an estimated amount, right, there are 3 factors that we don't know. We're not going to know who exactly is going to owe us the money, okay, or who is going to fault in their payment because it's an estimated amount. You're just throwing a random number out there and you're saying, well, if Isabel and Nancy and Mr. Sanchez decides to owe me money, I already know Mr. Sanchez is not going to pay me back, but how do I know Nancy or Isabel is not going to pay me? I don't know. So in this case, I'm just going to assume that it's a potential possibility that maybe Nancy will fault the next payment next month. Maybe Isabel will wait till the end of the year to stop the payments, right? I don't know. I cannot predict. Okay? So therefore, I have to take an assumption or an estimated amount to say that, well, it's possible that they could that you guys could potentially fault your payments in the future. Okay? Now, how much? I don't know how much each person is going to fault on their payment, but I do have a rough estimate, right? And like I've mentioned before, the IRS allows you to take up to 5% of your total sales, okay, to be considered uncollectible and write it off as a loss without any penalties. Okay? So in this case, my rough estimate is going to be just a rough number. It's not the exact number, but it's going to be an overall amount. And then last but not least, when. Now in this case, I never know when who's going to fault on their payment. Like I've mentioned before, right? I don't know when Nancy might lose her job. I don't know when, you guys are not going to make a payment to me. I don't know when. So in this case, at the end of the year, I'm just going to state my claim saying that, well, since I don't know when the possibility of these payments are not going to be met, then I'm just going to write it off at the end of the year or at the end of the month, just so then I can report my losses to the IRS properly. All right? So that's the difference here, where, again, the allowance for doubtful accounts happens during the year, while as you progress through it, and then eventually when that debt becomes uncollectible, then that's where at the end of the month, at the end of the year, you decide, well, realistically, it's been 6 months. This person's not going to pay me, so I'm just going to consider them as a loss. Okay? Any questions here? Okay.
Nope.
So then when we talk about writing off bad debt, there are 2 methods that we need to know. So if you guys remember in QuickBooks, when we had to do this for customers, right, where we had to create a credit memo in order to write them off as a bad debt. So in this case, this is the 2 exact methods that we were looking at. Now, if you guys remember, in QuickBooks, they teach you in the book how to do it if you are the tax accountant, which is called the direct write-off method, okay? Where it literally takes the bad debt directly off of the accounts receivable, just like this, right? You write the bad debt and you're taking it out immediately from accounts receivable. But according to GAAP, regular accountants cannot do that. Okay? Regular accountants cannot just write off bad debt whenever they want to. Okay? In fact, the GAAP tells accountants that they must use the allowance method, which could be broken down into 2 other extra methods, which is the balance sheet method and the income statement method. Okay? So in this case, because we're not tax accountants, right, we're just looking at the bare minimum of what an accountant is, we are not going to do the direct write-off method. In fact, we're going to go forth with the allowance method. However, I want to make sure that you guys understand that I will be testing you to know the basic knowledge of what the 2 methods of writing bad debt is. And you need to know that bad debt, the direct write-off method exists. However, it only exists for the purpose of IRS or tax purposes only. it's not what you should learn because you're not a tax accountant, okay? You need to focus on the allowance method, okay? So, with that being said, let's go ahead and talk about the very first method here, which is talking about the balance sheet method. So here we have a scenario, okay? Here we're given this information that a company has estimated that $25,000 of its $500,000 accounts receivable is uncollectible, okay? Um, there is currently a debit balance in the allowance for doubtful accounts for $5,000. Okay, so journalize this adjustment. So in this case, when we're looking at the balance sheet method, we need to look for three things. Okay, and that is at the top of the right is number one, what is the total estimated amount? Okay, in this case, my total estimated amount is $25,000 out of the $500,000 of accounts receivable. Okay? Second thing we're going to note here is going to be the word accounts receivable. Now, let's talk about the words accounts receivable. Okay? On the balance sheet, accounts receivable actually appears on the balance sheet. Okay? Right, where we list all of our assets, all of our liabilities, and our equity. So allowance for doubtful accounts and accounts receivable is going to be something that you view on the balance sheet. So therefore, when we're looking at this scenario, we need to make sure that this word is there, because then we know exactly which method to use, which is the balance sheet method, okay? So in this case, right, I have 25,000 of a total 500 accounts receivable. There's your keyword there. So that tells you that you're going to be using the balance sheet method. Okay? And once we figured that much far out, that means since the allowance for doubtful accounts does appear as well on the balance sheet, that means we care of whether it has a debit or credit balance. Okay? Now, if we understand that the allowance for doubtful accounts is a contra account to accounts receivable, we understand that that means it must have a credit balance at the end of the day. And in this case right here, we currently have a debit balance. So in this case, the estimated amount is your total ending balance in your ledger account or in that allowance for doubtful accounts. So if I currently have $5,000 in the debit side, right, and I need to get to $25,000 on the credit side, if you're looking at a number line, right, you have a positive 5,000, and then you have a negative 25,000 on the right side, right? So how do you going to get from the left side all the way to the right side? In this case, you need to go to the right side from 5,000 to 0, right? So that's 5,000, and then you need to take an additional 25,000 to steps to the right to get you to the total of 25,000 in the credit side. So in this case, right, best way to understand this if you're not looking at logistics is to memorize this. If there's a debit, you're going to add the two numbers together. If there's a credit, you're going to subtract the two numbers, okay? And I'll explain the credit side in a few seconds. So in this case, right, that means whatever the amount of balance I have in my current allowance for doubtful accounts, depending on which side it's on, and I know for a fact that allowance for doubtful accounts is a contra account to accounts receivable, so therefore it should have a normal credit balance at all times. So in this case, that's exactly what we're doing. We're taking the 5,000, right now it's currently on the debit side, so we need to get it to the credit side. So 5,000 plus an additional 25,000 steps is going to give me a total of $30,000 that I need to write off as my bad debt expense. Okay. Any questions here? Okay. Okay. So, like I said, so draw a number line, right? So, where now a lot of students had this question, where does this balance come from? Okay, where does this balance come from? Well, that's easy, right? What did we learn before we learned about bad debt? We learned about how to use the allowance for doubtful accounts, right? When there's a potential for bad debt. Now, then in this case, it can fluctuate. It can go back and forth, right? It can have a credit balance. It can have a debit balance. When we started off, right, it was a debit balance, was it not? Right? We debited the allowance for doubtful accounts and we credited our accounts receivable. So therefore, that's exactly why we have a debit balance in my allowance for doubtful accounts. But because we know that allowance for doubtful accounts is a contra account to accounts receivable, it's just supposed to flow in the opposite direction. How is that possible if during the year I'm debiting my allowance for doubtful accounts? That's where at the end of the year, when you confirmed that it is not ever going to be collectible again, that's where you need to take the estimated amount, and that's going to be your total outcome at the end of, that's going to be your account balance at the end of the year. So in this case, at the end of writing my bad debt off, I need to have a total of $25,000 on the credit side. But right now, I currently have a debit of $5,000. How do I get from that debit of $5,000 to get to my total credit of $25,000? How do I move from the left side to the right side to equal up $25,000 on the credit side?
You add the debit, or what you said, no?
Yes.
You add the two amount.
Yes, because right now you're on the left side. How do I get to the right side? You need to count or go to the right side, right? You need to do a credit. But in this case, I currently have a debit balance, so I need to add that amount in there. Okay? So then 5,000 plus 25,000 is going to give me a grand total of $30,000 that I am going to be writing off as bad debt. Okay? Okay? And you just do, is this clear or are you still confused?
I just take it. I don't know. I'm not so sure. I know it's not so clear. I don't know.
Okay.
I just accept it.
I don't want you to just accept it, but I mean, if you just want to accept it, then all you need to memorize is if you see a debit balance, you would need to add those two numbers together. If you see a credit balance, you subtract those two numbers. If that's what you want to go for, if you just want to accept it, then I would recommend you to memorize this instead of the actual logistics behind it. Okay? So in this case, right? That's the best and easiest way I can explain this, but if you really understand, when we do the exercise, maybe that will be a little more clear. Right? Okay. So then let's do another example. But this time, my company estimates that 25,000 of a 500,000 accounts receivable is to be uncollectible, and there's currently a credit balance of $5,000. Okay, in the allowance for doubtful accounts. So right now, my allowance for doubtful accounts is currently $5,000. But I need to get to $25,000. Now, if I already have a credit of $5,000, right? I'm already on the left side. I'm already on the right side, right? How much more do I need to get to reach the total of $25,000?
20,000.
Exactly. 20,000, right? Because you're already on the right side on 5,000. You need 20,000 more to reach that amount. So that's exactly what you're going to do. Okay? You're going to recognize that that's exactly what's going to happen. Okay? Again, the 3 things that you need to know when you're dealing with bad debt is, number 1, what is the estimated amount? In this case, it's $25,000. What word do I see? This is accounts receivable. So that tells me this is the balance sheet method because it appears on the balance sheet. And therefore, the allowance for doubtful accounts will affect my answer or my result. So in this case, right, I have a credit balance in my allowance for doubtful accounts. My end goal is I need to be at $25,000. So in this case, I'm going to only need $20,000 in order to reach to a total of $25,000 balance in my allowance for doubtful accounts. Okay. Question?
No?
Okay. So that was the balance sheet method. So now I'm going to talk about the income statement method. Okay. So you have the same exact scenario, except there's a little bit difference here. All right. It is estimated that 25,000 of a 500,000 total credit sales is to be uncollectible. Okay. And there's currently a debit balance in the allowance for doubtful accounts for $5,000. Okay. Now, in this case, right, we need to read this very carefully. Okay. On the income statement, right, I'm going to show you an example of an income statement. On the income statement, all we see here is going to be your cash sales and your credit sales. Nowhere on this entire sheet will you see the allowance for doubtful accounts or accounts receivable, because the income statement only focuses on total sales and your expenses, right? All of your income and against all of your expenses. So in this case, is an accounts receivable income? No, it's not. So in this case, right, when we understand that the income statement doesn't have accounts receivable, therefore, since there is no accounts receivable, therefore the allowance for doubtful accounts does not exist. It's not on the income statement. So how we're going to understand this is we're going to ignore that there is any balance in the allowance for doubtful accounts because it doesn't even appear on the income statement. All right? So therefore, we need to understand this. What are the two items that we need to look for when we're dealing with the income statement method? Number 1 is, what is the estimated amount? In this case, $25,000 is my estimated amount. Second thing is you're going to be looking for the key term, total credit sales. And in this case, that's exactly what I have here. I have $5,000 worth of total credit sales. So therefore, that should give you the automatic flag that means the allowance for doubtful accounts doesn't exist. It will not affect my estimated amount. So therefore, this is the easiest one because as long as you know which one is the estimate, that's all you're going to look for. Is that means your estimated amount is going to be whatever you're going to journalize. So here you're going to journalize the bad debt expense and the allowance for doubtful accounts as straightforward whatever the estimated amount was, which is $25,000. Okay. So in this case, we don't care about the allowance for doubtful accounts. We don't care about writing off the bad debt because in this case, we only care about what the total credit sales is. So in this case, the total credit sales is just going to be right there reflected as your total amount that you're going to write off. Okay? And now I'm going to give you a second example here, same scenario, except this time you have a credit balance of $5,000 in the allowance for doubtful accounts. If we stick with the method that we just learned, right, if we understand that the estimated amount is $25,000 of a $500,000 total credit sales, then all we need to do is just focus on one number, and that's just the estimated number of $25,000. So we don't care whatever is in the allowance for doubtful accounts. We just care about just the total credit sales. So in this case, boom, $25,000. Okay. Any questions here?
Nope.
So in this lesson, we took a look at understanding what happens when we allow our customers to owe us on an account, right? We consider that as an accounts receivable. Now, this is what happens during the year, right? Where you find out who doesn't pay you and you find out how much they don't pay you and you know exactly when. That's when you use the allowance for doubtful accounts. But once you reach the end of the year, end of the month, whatever it is, however long it takes you, and you reach up to the conclusion where this person isn't going to pay you, or you're going to make that assumption where there's other people out there who owe you money, and realistically, they're not going to pay you back, that's where you're going to make the assumption where you're going to create an estimated amount and create your adjustment entry, which is the bad debt expense. So again, during the year or during the accounting period, you will be using the allowance for doubtful accounts, right? This account is something that you can flip-flop for, okay? Now again, I told you about the two different types of methods, the direct write-off method versus the allowance method. And we said that the allowance method is broken down into two more different methods, which is the balance sheet method and the income statement method. Okay? So with that being said, right, the balance sheet method is where we are going to focus on the estimated amount. Look for the word accounts receivable, and that's going to determine to us that we do care about whatever account balance is in the allowance for doubtful account. If it's a debit balance, we're going to add those two numbers together. If it's credit, we're going to subtract. Okay? And then we're also going to talk about the income statement. All right? The income statement method is where we only focus on two things, right? Because that's where we know that the allowance for doubtful accounts does not appear on the income statement. So therefore, we only need to focus on two things: the estimated amount and the word total credit sales. Okay? So once again, when we are dealing with the allowance method, this is how we're going to be journalizing, all right? During the period when someone faults on their payment, we're going to recognize the allowance for doubtful accounts and we're going to take it off of the accounts receivable. Whereas the bad debt, we're going to actually write off our bad debt expense and take it right out from our allowance for doubtful accounts. Okay. So let's go ahead and dive into the exercise. So this might actually make it a little more easier for you to understand. So chapter 10.1, okay, it's going to be the the allowance for doubtful methods. Okay. So number one, on December 15, Robert buys a total of 100 coffee mugs at $9.99 each on an account. Sales tax is 8.25%. So let's go ahead and journalize this. So December 15, right? Okay. What happened here? How do we journalize that a sale has happened?
Accounts receivable, sales, and tax.
Okay, good, excellent. So in this case, right, how much was the total sales? If Robert bought 100 coffee mugs at $9.99,
$999.
$999. Okay. How much is tax on top of that? Or how much tax am I going to be collecting?
$82.42.
Hold on. $82.41.
42.
42. Good. 82.42. Okay. So that means how much in grand total does Robert owe me?
$1,081.42.
1,081.42. Okay. And I'm going to go ahead and write that sold 100 toys. Okay. Oh, coffee mugs. Okay. So in this case, on January 15th, Robert sends a check for $25. Okay. So how do I record a payment?
Check.
Good. Okay, checking.
Accounts payable.
Not payable.
Not payable. Receivable.
Yes, we're gonna.
Receivable.
We're reducing the amount that he owes me by $25, right? Okay. And then I'm gonna go ahead and say, Robert. Or actually, received payment from Robert. Okay. Okay. So then question number 3 says that on February 15, Robert informs that he can no longer pay due to his financial circumstances. So here, we're flagged right here that he just called us and said, I can't pay. So what are we going to do here? We know exactly who, we know exactly how much, and we know exactly when. Okay. So in this case, right, I'm recognizing that Robert can no longer pay. So in this case, what is this? This is potential bad debt, right? What do we call potential bad debt?
A doubtful account.
Allowance for doubtful accounts. Good. Okay, so I'm going to put ACCT. Okay, so good. We're going to recognize that he has potential bad debt, right? And in this case, where are we taking it off from?
Accounts receivable.
Yes, because in this case, we don't want to mix our accounts receivable with other people who make their payments, right? Because in this case, I'm separating it. So then I can make sure that I focus on this allowance for doubtful accounts, making sure that I try to collect the money as much as possible. So in this case, how much does Robert actually owe me now?
$1,056.42.
$1,056.42. So in this case, I'm going to go ahead and make a debit to my allowance for doubtful accounts for $1056.42. Okay, and I'm going to say, actually, I don't know what to say here, but yes. Okay. Allowance, or I guess bad debt, no. I think I just did allowance for Robert's accounts receivable. Okay. So there we go, 1056.42. Okay. Fast forward, it is now June 15. Okay, so what you've been doing between then is you've been sending him letters. Hey, you may not pay this month, but can you try to pay next month? Can you try to pay this month? And you kept exhausting your efforts to just continue to keep bothering him until Robert either pays you or don't pay you, right? So then on June 15, Robert says he can pay you another $25 at this month, and then he sends you another check. Okay? So you bothered him enough, and he said, okay, I'm going to go ahead and just give you $25. That's all I can afford. So how are you going to journalize this transaction that he's making a payment for you for $25?
Checking an account receivable.
Okay. Now, in this case, where is Robert's amount that he owes us?
In the allowance for doubtful.
In the allowance for doubtful accounts. So in this case, you are correct, Isabel. However, how do I get that money back into the account receivable? Okay.
So you account receivable and allowance for whatever it is.
Mm-hmm. That's correct, right?
That's
we have
good.
to reverse the transaction. So then now, so in this case, think of it this way, right? He told me he can't pay, so I'm gonna deactivate his account. Now that he says I can pay, I have to reactivate his account. So in order to reactivate it, I need to put it properly back into the account receivable and take it out from my allowance for doubtful accounts. Okay? And I'm going to take it for the 1056.42. All right, 1056.42. Now that I reversed it, and now I'm going to accept that he made a payment, right? I am going to recognize that I have my checking and that, yes, it is going to be for the accounts receivable. Okay. So in this case, right, he gave me $25 extra. Okay. And then I'm going to record this. Received payment from Robert. Okay. Good. Excellent. So then on July 15, Robert files for bankruptcy, and therefore he can definitely no longer pay us because the bank collector basically informed us that this money you can no longer be collected. Okay? So therefore, in this case, right, it is July 15. So This money can never be collected ever again. So how do I journalize this?
Do we put it as bad debt?
Okay, it's not the end of the given period yet.
Okay.
And this
Allowance,
good.
allowance for the full account
Mm-hmm.
and account receivable for 1,031.42.
Good. So in this case, right, we need to recognize that great. It's potential for bad debt once again, because right now we reactivated his account, so now we have to deactivate his account once again. So in this case, what was that for 10?
1031.42.
Good. 1031.42. Okay. And then once again, I'm going to make sure I write this allowance for Robert's accounts receivable. Okay. So then now on December 31st, your company has estimated that $2,590.54 out of its total $29,475.72 accounts receivable are to be uncollectible, which includes Robert's debt. Okay? And you have a total credit balance of $157.62 in the allowance for doubtful accounts. So now, what do we do here? Okay.
As a bad debit, bad debt.
Good.
Sorry.
Bad debt.
And it's allowance for doubtful account.
Mm-hmm.
Yeah. So you have to subtract here because it's credit, right? The amount.
Mm-hmm.
I know that.
Mm-hmm.
So for 157.62, 2,590.54 minus 100. That's the
Mm-hmm.
amount.
Mm-hmm.
Okay. So let me see. 34 minus 157.62. So it's 2,432.92.
Excellent. 2,432.92. And that's how you make this adjustment. Okay? Is this a lot more clearer now? So in this case, right, Robert may not be the only person I'm dealing with, right? If you remember, right, we're constantly um, uh, debiting the account and we're constantly crediting the account, right? Robert is not the only customer I'm dealing with. So in this case, at the end of the year, right? So again, those were all the beginning of the year. Maybe we had another person and we ended up with a credit balance of $157.62 in the allowance for doubtful accounts account. That's my ending balance. And what I need to get to is a total of $2,590.54. So that's how you do it. Okay. Is this much more clear?
Yes, I was missing the income statement, and that's the reason I didn't understand what you're talking about.
Okay, don't worry
It's so
about
clear.
that. Okay, perfect. Okay. Nancy, is this good and clear for you?
Yes.
Okay, perfect. So let's go ahead and move on with the. I think there's only a couple more questions left. So number 7, if a company estimates that, well, you also need to know that this are separate. They're not related to any of the questions above. Anyways, question number 7 says that a company estimates that 20,000 of a 500,000 accounts receivable is to be uncollectible. Okay, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts. What is the adjustment entry. Or sorry, the adjustment entry will be
Bad debt expense. Bad debt expense and allowance not full account.
mm-hmm.
And so it is it is a debit, so you have to add it's 25,000. No, I'm right.
In this case, let's see, 20,000, and there's currently a debit balance. Yes, you add them together to get 25,000. Okay, good. Okay. So then the next one says, okay, same scenario, except a company estimates that 20,000 of a 500,000 total credit sales is to be uncollectible. There is currently a credit balance of $5,000 in the allowance for doubtful accounts. What the adjustment entry will be?
Would it be the same line items, the bad debit expense and the allowance for doubtful account?
Mm-hmm. Mm-hmm. For how much?
The 20,000?
Correct, because in this case, right, because the key word here is total credit sales. The allowance for doubtful accounts doesn't appear on it. So therefore, we don't care about what a balance there is. All we care about is what the estimated amount is, which is to $20,000. Okay. All right, number 9, a company estimates that $20,000 of a 500,000 total credit sales is to be uncollectible. Okay. There is currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
The bad debit expense for 25,000?
let's take a look at this wording carefully. So the estimate is 20,000. Now, what's the word after the 500,000?
Oh, credit sales.
Mm-hmm.
So then it would just be the 20,000
Yes.
estimated.
Yes, because in this case, same thing here. It's the income statement. So the allowance for doubtful accounts doesn't appear, so we don't care what balance is in there. We only care about what the estimated amount is. Okay. All right. I think, yep, last one.
Can I ask you something?
Mm-hmm.
So the date from the journal that you journalized, you put the right away the end of the year, or you don't put a date? It doesn't matter. Oh, you have to put the date that you have on the exercise.
In this case, this one's kind of like I didn't specify what the date was. I didn't say it was December or anything like that, but yes, you're safe to assume that it will happen towards the end of the year. But in this case, where the questions above, I was specific on the actual date.
Mm-hmm. Okay.
So this one, it doesn't matter.
Doesn't matter. Mm-hmm.
No.
Okay.
But just know that it usually happens at the end of the given period. Okay? So it could be at the end of the month, end of the year, end of the quarter. Okay. So a company estimates that 20,000 of a 500,000 accounts receivable are uncollectible. Okay. There's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be,
Bad debit expense and allow for doubtful account, both for 25,000 because it's accounts receivable.
okay, so it's for accounts receivable, but what is the current balance in the allowance for doubtful accounts?
Oh, there's a credit balance of 5.
Yes, there's a credit balance. All right,
So
so
it only be the 20.
say that again.
Is it only the 20,000 or we subtract it?
Well, in this case, it's the accounts receivable, so it's on the balance sheet. So yes, it does matter whether there's a debit or a credit balance. In this case, my goal is to end the allowance for doubtful accounts with a credit balance of 20,000. I'm already $5,000 in. So how much more do I need to get to 20,000?
Oh, 15.
15. So in this case, I do need to subtract the number out. Okay? Because it is a credit balance. Okay? All right. Any questions in regards to this? Good. This is very similar to the exam, so that's what I'm going to be testing you on. Is I'm going to give you a scenario where I'm going to ask you, if a company estimates that blank blank of a blank blank and there's a current blank blank, you need to know which method that you're using and how to calculate the amount of bad debt that you need to write off. Okay? And as far as understanding the allowance for doubtful accounts, that's going to be more so for the class project. Okay? Any questions in regards to the chapter 10.1, receivables?